Hello and welcome to this week's instalment of Nucleus Investment Insights, and we've entitled today's one, The Death of Value. So we're going to be doing a deep dive into the prospects of value investing, a little bit of a look back over how value investing's gone and where we think it's heading in the future, and whether or not it's coming back. I'm joined today, as always, by our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim. Thanks.
And
the key thing as well that we'll be hitting up is this whole part about value is meant to be saving you, and right now the market's we've had a few ructions in the market, and value hasn't been saving investors. So that's the key part while we're focusing on value today.
Okay, sure thing. So let's jump into it. So the agenda today, we'll be looking at the death of value with a question mark. We'll then be doing a quick quant recap, diving into exactly what value is, and then looking at where to expect problems. Finishing up, as always, reflecting on how this entails in the way we run money every day at Nucleus Wealth as well, Damien. Yep. Fantastic. All right, lovely. So let's jump into it. So the death of value. Ouch. You might need to run us through this chart.
Yeah, sure. So I've just put up the most common measure of value, which is the MSCI World Value Index versus the MSCI World. They run this for all different countries around the world, and we're seeing very similar results. Pretty much doesn't matter where you look. That value, which is meant to be this consistent outperformer over time, has not been outperforming, and particularly in the last 2 or 3 years, has been significantly underperforming the world markets. And so what I wanted to do was just sort of define the problem a little bit, and jump in and say, well, why? Well, where? So let's have a look where and why, and so sort of hopefully once you get a bit of that feel for that, then you can actually get into working out, well, is this just something that's a momentary effect that's happening at the moment?
Yep.
Or is this actually something sort of structurally that's changed, and we need to keep that into mind as we're doing the investment? Okay,
sure thing. Roll into the next one.
Yeah, so there's a few sort of I guess what I'd call quite troubling from an asset allocation point of view look at value, and this is sort of all from a very much a top down perspective. So what I'm showing here is what we call return spreads between the first and the fifth quintile.
Okay.
And what that basically means is you take all the stocks and you put them into different categories. 5 different categories based on the valuation is based on how expensive they are down to how cheap they are, and then you look at how does the cheapest perform versus the most expensive, and then all the different other categories within that. Sorry. And what you find is that value, hopefully you can see on these charts, it actually is a little bit smaller than I was hoping, but basically value has underperformed significantly. I've got US large caps and European large caps, and it's basically been about 15% under for both those over the last 2 years.
Wow.
Or since the start of 2018. And so that is a meaningful underperformance. And that's basically saying, if I went out, so at the start of 2018, if I were using the traditional measures of value, if I went out and bought the most expensive stocks and shorted the cheapest stocks, then the net effect would have been a 15% gain.
Yeah, right. That's
above whatever the index did.
Yeah. That's our performance. Yep. And just a note too for those listening in, there will be a link to the content, the slides today in the show notes as well as always. So yeah.
I've got up a few other ones there, just some of the other factors that sort of that go into sort of traditional quant models, and you can see of all the ones we've got, value has been the worst performer. So whether it be if you're looking for price momentum or earnings quality or analyst expectations, whatever your measure is, value has been by far and away the worst performer over that period. And then you say, well, okay, there might be some reason for that, in that value is meant to be a strategy that is there for your protection. So when markets are booming, and markets have boomed over the last few years, a few pullbacks notwithstanding, you generally don't expect value to do that well in those scenarios. Value is there often to save you when markets pull back.
Okay.
But so just flicking to the next slide, when you actually start digging into some of the some of the figures, some of the month by month figures, the trees, I'm saying, look just as bad as a forest looks from this perspective.
Right.
Because so the two big, this month hasn't been a good performer so far, and another, December 2018 was a shocker in terms of markets pulling down, and that's when you wanted value to save you.
Yep.
And just looking at the US and Europe, in both those cases, value didn't. It was actually, again, it was an underperformer. So not only in, say, December 18, when all these markets are pulling back and we're seeing this, your absolute value go down, if you'd piled all your money into value thinking that value was going to save you, you lost another 2% on top of what you lost on the markets.
Wow. Yep.
So, and almost 3% in the US. So it's this part about saying, well, there's clearly something wrong here, because going out and trying to find the most expensive stocks and buying them doesn't seem like a strategy
method
that should work in the longer term.
Yeah,
So the next stage is then saying, well, let's jump in and have a look at some of the some more of the detail. Yep. And I've got a couple of slides up. One is one's based on the sectors. So this is just looking at the last 2 years. The first slide is based basically looking at each of the quintiles, because usually what you'd expect, if you've got a factor that makes sense and there's a structural reason for it, is whatever sector's done the worst will be the worst factor. So ordinarily, let's say we're looking at value. Over the long term, if I showed this same chart, what would happen is the most expensive stocks would have the worst performance, the cheaper stocks would have the best performance, and they'd all be in line, pretty close to in line as you go up that chain. And so you're saying, well, because what we're trying to work out is it just a bit of a random scatter, and it just happened to be that the lowest quintile did worse than the best one. Okay. So this is just showing over that 2 year period, and you can see that they're relatively in line, but it is more of a factor of if you were cheap, if you were average cheapness or very cheap, average to very cheap for those three quintiles, the performance was pretty similar. And it was actually the expensive stocks that tended to outperform. Yeah, right. Okay. Over that period. The other thing I've looked at is still no real answers for us in that. The other thing to look at is the sector by sector performance. Sometimes what you find is one sector in particular, or especially some big sectors, will actually overwhelm what's happened in some of the other sectors. Yeah, sure. But it's been pretty much across the board. Energy, you've done all right doing buying cheap versus expensive. Yep. Having said that, energy's got its own special sort of its own issues, and often that actually doesn't. Factors. Well, often that doesn't actually work in energy, and most resources it actually doesn't work buying cheap and selling expensive. So, so although that's your one sector that has actually gone the way you expected it, every other sector's gone the opposite way. Yeah. Right. Yep. So so I guess sort of all that sort of leading to that same point is there's something seriously wrong with value when this is showing. If you dig into the next slide, I've got where I break out some of the individual factors. Now, for the sake of consistency, I've sort of used S&P data here. What I'm showing here is that there's you can see which of the factors actually led to this. So in the year to date, for example, sales to enterprise value has been the worst performer. Okay. And the best performer has been the free cash flow to price. So if you actually look across this for free cash flow, what you find is that the cash flow measure has actually been doing all right. So if you've got this, if you're actually digging into the numbers and looking more at cash flow numbers and less at book values, then value's actually done a lot better. Okay. Within that perspective, if you look at forward earnings, it's done better again. So there's this whole part about saying if you're too focused on historical earnings and book values and those types of measures, the worse you've done. Yep. There's another measure called EBITDA to enterprise value, which is the earnings before interest, tax, depreciation, and amortization. That's got lots of its own issues in terms of how you use it, but that's also been a really bad performer, and that's probably one of the lines that's most susceptible to management adjustment of your numbers and tweaking. Yeah, exactly, and making things look better than what they might actually be. Yep. At the underlying level. Okay, so we've got this big issue we're saying where value has been a very bad performer, and it looks though when you dig into it, that, and it doesn't matter how you measure it, countries, regions, sectors, whatever it is, you're getting the same result. When you dig into it a little bit closer, you can see that there are some factors that are doing as you'd expect, but by and large, your P&L and your book ones. So I sort of thought that's I guess setting the scene for the rest of it. Then I wanted to sort of flow into a little bit more about value, and sort of and a little bit about quant, just so that you're putting into perspective how you should be using quant. Then a little bit more specifically about value, and then finally sort of cap up with, okay, what does it actually mean for your investments? Okay,
sure. And just a note there, for those that are listening in, feel free to drop any questions in along the way as well, and we'll get to those in due course. So. Quant recap introduction. Let's get into it.
Yeah. So I'll flick through this because I've done this. There's a couple of other podcasts we've done where I've gone into more detail on these. You can find them in the libraries. But I think there's the couple of key things to note is a quant is a mathematical model to actually try and help generate performance. It's not a magic formula to beat the stock market. They help. It's about managing to find. It's about trying to get the reasons behind it though, and whenever I'm out trying to look at measurements and how we're gonna incorporate different factors into it, it always needs to come back to, well, why is this an important measure? Because it's, with all the computing power nowadays, it's very easy to create your own machine learning model and spit out these answers about this great portfolio and how it would have performed, always been up regardless of market conditions. And then as soon as you start, when you back tested it, but as soon as you start getting in the real world, then
falls apart
because it's got some weird thing in there where it's only buying companies start with the letter R on a Tuesday or whatever it is that's sort of come into. If I had done that over the last 20 years, it would have been
that's
great
right.
performer. But it's
pattern finding in the past is not always going to work in the future.
Exactly. And so quant models need to come back to why. Every time you're using one, it needs to be why is it working. And so the value model makes sense in terms of saying, well, if I buy cheaper things, they should generally do better than more expensive stocks. But with a number of disclaimers, which I'll get onto in a minute. So there's also this implicit assumption about non-reversion in a lot of these models. Value is actually different, and I'll move on to that later. But there is this thought about saying, well, if I go and find a company that I think is high quality, then there's an assumption in there that it's going to remain high quality. If I go and find a stock that is got momentum behind it, there's a positive momentum behind the share price. There's an assumption in there that it will keep having that momentum. And almost all quant methods have that implicit assumption behind it. Value is one of the rare opposite cases where you're actually making the assumption that it actually will revert to mean.
Okay, sure.
So anyway, we'll move into that.
That makes sense. Yeah.
The other key thing is the other key question I'll always ask is, are you selling insurance to the rest of the market? And what I mean by this is, there's a famous book out there, The Black Swan by Taleb, and the key thing I took away from it, anyway, I think different people take away different things from that book, but the key thing I took away from it is there's a whole part about saying, if you are selling insurance to everyone else, it feels really good on a day-to-day basis. You make a small profit every single day. I could go out and decide to take home insurance from everyone in the office, and every month I get a couple $100 from Tim and a couple $100 from David and Leith and all the guys keep giving me all this money, and this is fantastic. Just money comes in. One day somebody's house burns down. It's like, oh, I've got to spend $700,000 to rebuild somebody's house. I've only collected enough, 10,000, 30,000 or whatever it is. There's all of a sudden it doesn't feel so good.
Sure.
And there's a lot of quant strategies that are similar in terms of saying there's a liquidity, or there's a factor in the market, there's a risk, and people don't want to be taking that risk. And so they're basically saying, well, I'll pay a little bit of money not to take that risk every day. I'll let you have a spread. I'll let there be an arbitrage on from this to that, because I don't want to run for the sake of a cent or 2 cents that they can make on that trade. I don't want to lose $1
down the track at some point,
once every 3 years.
And
sure. So that's where this, are you selling insurance, digging into it's not just a quant model spat out the answer and said, yes, this is a great strategy, it always makes money. Over my 3-year testing period, I've got to keep doing it. It's like saying, well, no, what is the fundamental reason for it making money? Is it because
the accident hasn't happened yet?
Exactly. Or the accident does happen, it just happens every 5 years or every 10 years or whatever it is.
Gotcha.
Okay, so when we go to some of the key quant methods, momentum, which is basically you buy stuff that goes up and it tends to keep going up, and you sell stuff that goes down and it tends to keep going down, which is sort of the least intellectual, but it works.
Yep.
A lot.
Herd theory sort of thing.
And it's sort of why there's all the charting and all these CTAs. There's billions of dollars behind it.
Yep.
It's
what's a CTA? Commodity trading.
Trading advisors. So basically people who are flipping between different asset classes.
Yep.
Usually when they're saying, okay, well, this bonds have just had a great run. I'm going to keep pushing until it hits certain resistance levels, or it starts to slow down, and my momentum on them now tells me now it's time to flip back into equities or flip into whatever the next one is.
Okay, sure.
Low volatility is basically and so the assumption behind that momentum is that there's no mean reversion.
Yep.
Low volatility is an interesting finding that basically if you buy stocks that are low risk, they tend to actually outperform higher risk stocks, which is the opposite to what theory says. And again, you're making a bet though. There's no mean reversion on that one. Growth is similar. You're expecting if I buy growth stocks, and they'll remain growth stocks and they won't revert back. Quality is the same. If I buy a high quality stock, it'll always be high quality. Value is the black sheep of those of the key ones there in terms of when you're buying value, you're making this assumption. So that what you're sort of doing in a way is the opposite to that insurance we were talking about, and that's the way value has tended to perform. Is that you're losing or you're underperforming by a little bit all the time, only to find that every now and again there's a market blow up and all of a sudden value comes good.
It takes good. Yeah, it takes off. Yep.
The thing is, it doesn't usually mean 2 years of minus 15% underperformance is a big performance. And actually, sorry, that was the top versus the bottom, but the underperformance hasn't been as big in value, but it's been big. And so I've got a chart up there sort of showing some of the examples of how that comes out. Is that you tend to go. This is what I'm showing is the basically it's a 45-degree line of showing when value outperforms in the green on the left and when it underperforms in the red on the right. And you do tend to find value will outperform, but every now and again you get these
periods of underperformance.
These periods of underperformance, and the tech bubble is one good example, and most recent times is another one.
Yep.
So over 5-year periods, value has tended to outperform. It hasn't over the last 5 years. It's been a big underperformer. So let's get a little bit more into what value, how it's defined by MSCI, because that sort of gives a bit of an indication of where things are going wrong.
Yep, sure.
So MSCI defined it as the book value, forward earnings, and dividend yields. So the key things to note there is there's no cash flow measures. So we had a look through some of those factors, and cash flow was one of the big factors there.
Yep.
You do have different accounting standards between different companies, and it's also reliant on forward PE, which is the
guess.
Yeah, guess, but it's also there's always numbers where companies will say, oh, I'm going to learn 50 cents in earnings per share next year on this basis. They're adjusted for this and adjusted for that. It doesn't have these write-downs or whatever, and that's going to be 50 cents. And that's what analysts are putting in as their forward earnings. Then what happens in reality is the company comes out and has, we wrote down some restructuring charges and we did this and we did that, and we actually made a 10-cent profit.
Yep.
But 50 cents was the normalized number, and also for next year, well, that's what we're baselining everything. So we're still looking at, so next year we're going to earn 55 cents, even though we thought we were going to make 50 cents this year, and we only made 10, but the whole time through, we've always been telling people, it's 50 cents, 50 cents, 50 cents. Oh, they're just write-downs, just ignore those. And analysts putting into their models 50 cents, now it's going to 55.
Yeah, right.
And so you don't see that sort of downshift in it. And what that means is that if you're only looking at forward earnings, and that's the only thing you ever look at, is you miss that. So within the MSCI numbers, you're looking at, no cash flow measures. You're looking at forward earnings, dividends, which used to be more important. So they're still important, dividends, but there's been the big news in the market over the last 2 or 3 years has been the huge amount of buybacks that have been going on. Yep. And in the end, a buyback and a dividend is very similar in terms of saying the company is giving money back to shareholders, and that's that's a good sign. Whether they're buying back shares of some shareholders, so that they get capital appreciation for other shareholders, or whether they're paid out as a dividend. Lots of arguments about positive and negatives, but it's a very similar sign. The MSCI value index is only capturing one side of that.
Right. Yeah.
And so
sure.
so you've missed that. And the other bit is this reliance on book value, and this is this is one back to the Ben Graham times of saying, you need to look for stocks that are trading below their book value. And this was like the whole intelligent investor, and it's there's a whole story behind it and an investing methodology behind it, which makes sense, and I don't have any problem with the investing methodology itself. The issue I have is that what's being measured is not the same. So when Ben Graham was writing his book in the 1950s, what was called book value and how it was measured is very different to what's happening today.
Yep.
And so there's this overriding factor, which is this book value sitting there, and today's book values have this downward bias where they can go down, but they basically can't bounce back up again. And so what's happening is we've lost we're looking at this value measure, and of the three things, they've all got certain flaws, which isn't a problem in its own right. But if you're only using three and you're not using other methods, then you end up running into trouble, which is where value's gone. And so and keeping in mind that when you buy a smart beta value fund, this is what you're buying.
Yep.
And this is why a lot of people sort of have issues with smart beta, is because smart beta sort of is not that smart. Sort of, they say it's dumb beta smart marketing, basically.
Yeah, right.
But it's
might have been smart in the 50s, but
well, and some of these ones where they say yes, this has a 50-year history of book value, has a 50-year history of outperforming or whatever. The last 10 years haven't been so good, but 40 years ago that was had great guns. It's like saying, well, yes, but accounting standards have changed, and so how do you know that it's going to be the? So maybe it will, but I think there's certain measures where, for me certainly, I look at the book value and say, well, I can't rely on back tests for those ones. If I can see a fundamental reason why the book value is there and everything, I can have an argument to buy it on a book value basis, but it's not just as simple as let me just rank all the stocks by cheapest on a price to book. And buy them. And
buy at the top. Yeah, okay, sure thing.
So some of the other things we do. So first, we want to try and look at, you want to be looking at your earnings and different levels of earnings and matching it and working out where there are problems. Cash flow is a big one. So cash flow is a lot harder to fake than earnings. You still can get accounts done incorrectly with the cash on a cash flow basis, and you do need to normalise between countries, and there's normalisation for whether it's got interest or not in various measures, but cash flow is a lot easier or a lot harder to fake than earnings. There's these deep value measures, which is the price to book, price to sales, all those types of ones, which are quite a small factor in what we do.
Right. Okay.
Just in that I don't think they're that reliable, and the last 2 years have been very much testament to those. All these deep value measures have been the worst performers over that time period.
Is that right? Yeah. Okay. Yep.
And then there's this whole idea of shareholder returns and what are you getting back for what's coming in versus going out, because there's a...
So is this in a sense capturing both sides of that dividend and buyback sort of problem we found before?
Yes, partly that, but also looking at what's happening to earnings and payouts, because if a company's, for example, going backwards with its earnings, at face value, people are like, oh, that's a bad thing. But if it's actually paying out large chunks of its capital, say it's a company that used to be a manufacturer like an IBM, and now they're turning into a service company, and so they've actually got all this capital they're throwing off, and so they're doing buybacks and special dividends and all these other types of factors, then that's actually that might be a good outcome for that company. A company that's ploughing lots of capital into it and getting the same result, it's obviously a bad result, but the value is related to how much money's coming in and going out of the company as well.
Yep. Okay.
So we tend to try and look across, first of all, across a range of different measures, and looking at sustainability and as you said, buybacks and capital returns. The other thing is the timeframes, which is is not being too focused on one time frame. I like to try and look across three main different timeframes, but various subcategories within that. There's this idea of long-term value and looking at inflation-adjusted earnings and purchasing power parities across, so you can sort of normalize for currency exchange rate movements and things like that. Looking at cyclical companies, because what tends to happen is a cyclical company will look really cheap right at the peak of its cycle. So its earnings are running up. Everything's been going well. It's a type of company that always trades in these big cycles. And so at the peak of its earnings, everyone in the industry is saying, hey, this is as good as it gets. I'm not paying 20 times for this company. I'll give you 6 or 7 times PE for it.
Yeah, right. Okay.
And that's the time when these value models are saying, hey, why don't you go out and buy this? Look at it, it's only 6 or 7 times earnings. Whereas if you're running the longer term models and sort of running effectively little trend lines through this, saying, well, yeah, that's your top one, but your average earnings on an average earnings basis, maybe it's trading at 13 or 14 times. So ignore the current stuff. Let's get on to what's going to happen. And for some companies, so sort of basically saying, well, I want to look backwards over a reasonable time frame. I want to look at current because current's important. I want to look forward. Because if you're looking at a company like an Apple or a growth company like an Amazon or someone like that, well, you're never going to buy it based on what they did over the last 5 years.
Yeah, sure.
You're relying on the fact that this year and the future years are going to make up for it. So it is horses for courses. You can't sort of rely too much on one, but you need to know why I'm buying. This stock's showing up as a value screen. Looks terrible on current, terrible on future value, but actually its long term is actually pretty good. And so now what am I taking a bet on? I'm taking a bet on that this is a cyclical company. Now you can go back and decide, okay, is it a cyclical company or is it a company that's just dying? And then make that decision and then make your investment. Versus the growth companies where you can say, okay, well, I can actually throw away some of the older stuff and focus more on the forward looking ones, because that is where the money is going to be.
Sure. Okay, sure.
And then you can look at different universes. I'll actually skip past that just for in the sake of time. But yeah, looking at whether sectors versus countries and business models, because you just want to make sure that, I was using that example of the EBITDA, you don't want to be comparing a service company to a manufacturer on the wrong measures.
Absolutely. Yeah, no, that makes a lot of sense. We've got our quick shot here of our quality value scattergram, and probably a piece in this was, and we'll spend some time on it now, of talking about we do actually use value quite strongly throughout our investment methodologies.
Absolutely, yeah, and hasn't been the best performer for us, but it certainly hasn't been anywhere near as bad as what we saw at the start. What we've been seeing at the start. Mainly because we've focused on two things. One is that we think are more important measures. But the second issue is value's almost always a trade-off. If you're buying a stock just because it's cheap, quite often that's just a recipe for trouble.
Yeah, sure. Have we got an example of something that might fall into that realm? For those?
Look, any blackberries or something like that, where you say, okay, the stock's on its downward cycle. It's on its heading to zero.
It's never been cheaper because no one's got the phone in their pocket anymore.
Exactly. So the idea for me is this: value is almost always a trade-off between I'm either looking for quality or I'm looking for growth or some other factor that I'm trying to get out of it. And value is like a benefit I'm going to get. So if I'm looking for, we're very focused on quality stocks, and so what we're saying is, okay, well, if we want to buy a very high quality stock, then you know what, it can be average value or even a little bit expensive, and I'm still happy to buy it.
Sure.
Whereas if I'm just buying an average quality stock, then I need it to be cheap. Before I'm going to buy it. And so for me, that's the trade-off. You get the same trade-off for growth if you're looking for growth stocks. The question about, it might be a great growth stock and it might grow, but if you're paying say WeWork prices for it, then the chances of success are lower than if you're buying into at the first round of the capital raisings and you're getting
pre-IPO stuff.
Exactly.
Sure.
So. And that sort of factors on a lot of these different models. So some of the other ones, we had the momentum and the low volatility. Low volatility is another good example of one where I spoke about low volatility stocks being great performers and completely counterintuitive or counter to economic theory, saying if you buy the least risky stocks, they go up the most. Part of that's been interest rates coming down, but there's also a part of it's been they've actually got a lot more expensive, those stocks. So they were very cheap 20 years ago when most of these people when most of the measures start looking at it, and now they're not cheap. And so the question for those is saying, well, I'm playing that trade-off between, yes, I can get my low volatility, which is good. I want to have stocks that are safer, but I also need to keep in mind the valuation side of it and how am I accessing that. So that's how we use it. We also have that whole different time frame section where we'll look at the same factors and I break down each of the value factors. I want to know what are the key things that are driving this, which are the bad ones, which are the good ones, what does it look like on a forward basis versus a historical basis, and those types. And so that's probably enough of a factor of value. So now where are we going to get problems? What I'm saying, I've said this a few times, but it's a tool, not a religion for quant. Now value does tend to be a bit of a religion.
Okay.
There's a number of I'll call them regional practitioners and book writers and seminar promoters and newsletter promoters, and they, I think the whole sales pitch is Warren Buffett is the god and I am his disciple on this part of Australia or Canada or wherever Warren Buffett is, and this is what I'm selling. I'm selling seminars to how you too can be like Buffett and you can buy value.
Yep, sure.
And so I guess what I'm trying to come back to is you do need to treat it not as a religion. Value is great. I want to buy cheaper stocks rather than more expensive. Absolutely, every day of the week.
Yep.
But I don't want to buy stocks just because they're cheap. I want to buy them because they have other factors that are actually useful, and there's not a stock that's you look at it as trading on a 7% yield or 7% dividend yield, and great, this is fantastic, I'm going to make all this money from it, and then the dividend halves, then the stock halves, and they're still trading on a 7% dividend yield, but it's half the price you just bought it for.
Yeah, that's right.
So and you get a lot of years of that 7% to make up for the 50% you just lost.
Absolutely.
So very much for value, come back to that. It's not just a blind buying, because right now is at the stage where the other problem with value is, as a value manager, when you're looking at value managers, I spoke about how the performance tends to come in spurts. So you get sort of negative, or a little bit underperformance, and all of a sudden you get it all back in one go.
Yep.
And the problem with managers is, if you're looking to lock your money away for 3 or 4 years with this manager, and the last 2 of them have just done minus 15% on the rest of the market,
you're probably off. You're gone.
You've got to sit there and know, well, and maybe they'll get it all back in one go.
Yeah.
Or maybe they're looking at the wrong factors. Who knows? But you don't know that either. Like, you don't know if there is. There's this argument about, is value dead? Is value never going to outperform again?
Yep.
I'm saying, well, I think part of it's a measurement issue.
Yep. But
the other part is it does come in spurts and drabs, and so you do need to feel confident that the person you're in actually is sitting on the right value measures, and they're not buried in measures that were great 50 years ago, and they read, I've read the Warren Buffett book and the security analysis by Ben Graham, written 50 years ago, and I've taken all his notes and applied it to modern day accounting. And
just a quick question there, how would your average investor actually be able to get the insight into making sure that someone is using a non-1950s set of metrics for today's market?
Absolutely, it's very difficult. Well, it's difficult. I mean, you can run through what they're doing and speak to them about the factors, but it is difficult. I mean, there's a whole industry that's of asset consultants that spend most of their life trying to work the same thing out.
Yeah, right. Okay.
And so, and then the people who are the sort of strict adherents to, price to book has worked for 100 years and it's always going to work, and you just need to have faith. It is a faith-driven one. It's about saying, have faith. This is it's back to that religion.
Yep.
Your value is your religion. You're a worshipper at its altar.
Yep.
And you need to have faith that I'm the high priest and I'll deliver the.
At some point.
At some point in the future, which
might be at the pearly gates, but you never know.
Exactly. And so, so I guess I think value is there. I think there is lots of reason to use value, but I'm very concerned about how it does get used in practice at the moment.
Sure. Yep.
So you need to change it with accounting standards. It's always a trade-off. You always need to be working out, what am I getting for my value versus what I could have got elsewhere.
Yep.
And what other factors am I getting? If I'm just getting value and crap companies with no growth and no quality, then you're in the wrong stocks.
Yeah, sure.
And keeping in mind that there's that mean reversion bet you've made. The other net effects I want to sort of spit out is that so value is not dead. I don't think it is. There is value there, and then there are elements that are still working. I do think it's hiding, and I do think there's some what I call superficial value.
Yep.
And that isn't value. And so if you are looking at the traditional measures, and all you're looking at is some of the, this is what the academic texts and said work, then I think that value is dead for you. Or certainly it's turned into a scattershot of there's no longer a particular reason for it to be there. But if you are digging deeper into the numbers, looking at a mixture of different timeframes, you are looking at cash flows and other factors, then I do think there's still scope for value to give you that same protection. Yeah,
sure. Yep. And it's just about really making sure that the managers that you've chosen are following that philosophy and not.
That's right. They're not sort of, I'm using this because it's worked for 50 years and I'll be on the golf course if you need me.
Pull a lever and something pops out. Okay, very good. All right. Well, thanks very much, Damien. We'll roll into to next week. So we're looking at we're revisiting our topic that we touched on at the start of the year. So with the RBA cutting a couple of times this year already, bond yields have plunged, meaning bond prices have roared away.
That's right. I think we spent that time talking about how we thought bond, they're over 2%. We spoke about how they could get down towards 1%, and now we're below.
That's right. So we thought a great time to revisit that one. And
way faster than we expected.
Yeah, that's right. Yeah, so bonds away 2.0. So that's same back time, same back channel. Thursday, the 22nd of August, 12:30 p.m. Australian Eastern Standard Time, and head on over to the Nucleus Wealth live webinar page to watch live and also have any questions answered as well. So really looking forward to that one, and we'll see you there. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you with the next one. Cheers.